Namaste. In this video, we will discuss about income taxes. Those are dealt by IND AS 12. Objective of IND AS 12 is to prescribe accounting treatment for income taxes, presentation thereof, and disclosure requirements. It applies to all income taxes, whether it is domestic or foreign taxes. IND AS 12 applies to taxes based on net income. Therefore, taxes those are not based on the net income are out of purview of India's tax. For example, wealth tax. India's 12 does not apply to accounting for government grants. It is dealt by India's 20 and accounting for income tax credits, investment credits, etc. However, India's 12 deals with the accounting for temporary differences arising out of the accounting for government grant and accounting for investment tax credit, etc. Deferred tax is amount of income tax that is payable or recoverable in respect of the temporary differences or unused tax credits or unused tax losses. Deferred tax is calculated by multiplying the tax rate to the temporary differences, and temporary differences are arrived by reducing the tax base from the carrying amount. So if we look at the differences between the deferred tax and current tax, there are three major differences. First is of the substance, that current tax is the actual amount payable to tax authorities in respect of the current year, while deferred tax is measure of accounting measure that reduce the distortion of the result in respect of tax effect on the current year transactions and events that have occurred. Another difference is of basis. While current tax is based on the taxable profit and loss, and a deferred tax arise because of the temporary differences. And next difference is of timing. While current tax is in respect of the current period, while deferred tax is the tax effect of settlement or recoverability of assets or liabilities and transactions in future periods. So accounting profit and loss is profit and loss that is recognized based on the accounting principles, and it is before the deducting tax expenses. And taxable profit and loss is profit and loss for a period that is determined in accordance with the Income Tax Act. There may be difference between the accounting profit and taxable profit, and it may be because of the different reasons. For example, expenses that we have recognized in accounting P&L but are not deductible for tax purpose. For example, payments under section 43B. Another reason may be income that is not recognized in accounting profit and loss account, but it is included while determining the taxable profit. For example, revenue that is taxed based on the receipt basis. Another example may be expenses not recognized but are deductible for tax purpose. For example, accelerated depreciation. And income that is recognized but not under income tax laws. For example, income accrued but taxed on cash basis. So there may be these few differences and other difference, region of differences also between accounting P&L and taxable profit and loss. We need to decide how to account for the tax consequences in case of future recovery or settlement of assets and liabilities. So recovery or settlement of asset or liability either will make the tax payment on higher side or lower side. So in the same way, based on the case, we need to either recognize the deferred tax asset or we need to recognize deferred tax liability. In the same way, we need to look for the booking of income tax on the transaction and other events in financial statement. So Ind AS 12 gives a very simple method to recognize it. We need to recognize the impact of taxes in the same way the way we have booked the impact of transaction or event. If the impact of transaction or event we have taken into PL, the tax impact of that will be booked in PL, and if we have booked the impact of transaction or event in OCI or equity, the tax impact of that transaction that has gone in OCI and equity will go in the OCI or equity respectively. Let's understand the current tax. It is the amount of tax payable or recoverable as the case may be in respect of the taxable profit and loss for a period. So how it is calculated? It will be taxable profit and loss multiplied by the effective tax rate for that period. And the accounting will be, we will debit it either to P&L or OCI or directly to equity based on the transaction on which the differences has arisen. So if the impact of transaction has gone in P&L, we will debit the P&L. If it has gone into OCI, we will debit the OCI. And if the transaction effect is directly booked in equity, we have to carry the difference for that particular part in equity. And we will create the provision for taxes. Tax base is the amount that is attributable to an asset or liability for tax purpose. So if we look at the asset, it is the amount that is deductible for tax purpose against any taxable economic benefits that will flow to an entity when it requires the carrying amount of that asset. Similarly, in case of the liabilities, it is carrying amount less amount that is deductible for tax purpose in future period. In respect of the revenue that we have received in advance, tax base is the carrying amount less revenue that is not taxable in future period. There may be some cases where these items are not recognized as an asset or liability, but they do have tax base. For example, preliminary expenses are recognized as an expense in determining accounting profit in the period in which they have incurred, but may not be permitted for deduction in determining the taxable profit until a later period. So it results in DTA that we will discuss in next slides. Temporary differences are the differences between the carrying amount of assets and liabilities and its tax basis. In case where the carrying amount is greater than the tax base, it results in taxable temporary differences. For example, in case of the receipt of interest revenue in advance, we have booked it as a liability in our books of accounts, and it will be taxable at the time of actual receipt of the interest income. So it will result in deferred tax liability. On the other side, where the carrying amount is less than the tax base, it will result in deductible temporary differences. For example, in case of preliminary expenses, we have booked it in the profit and loss account and there is no carrying amount of debt, but it is deductible as per the tax base in later period. So it will result in deferred tax assets. Another example of deferred tax assets are where we have the tax losses and unused credits and that we need to carry forward. So in this case also, we will generate the deferred tax assets. Deferred tax assets or deferred tax liabilities will be measured based on the tax rate that is applicable in the period of recovery or settlement, or tax rate that is applicable or has been enacted or expected to be enacted. Apart from it, when we are measuring the DTA or DTL, we need to check about the manner in which we are expected to get the economic benefits from the carrying amount of the asset or the liability. So according to the manner, we need to choose the tax rate. For example, in case of the asset, if we are going to get the economic benefit out of the asset from the uses in the business, the tax rate of business profit will apply. And if we are going to get the benefit from the asset, carrying amount of the asset by selling it in market, we are going to apply the capital gain tax rates. So these two things will be just based on the usage and rate while measuring the DTA and DTL. And next thing is we are not going to discount the DTA or DTL. Income or expense in respect of the deferred tax will be recognized in profit and loss account. However, it has some exceptions if the transaction has been recognized out of the P&L, maybe in OCI or in equity. So effect of deferred tax will be recognized in either OCI or in equity. So the principle is where the impact of the transaction has been booked, whether in PL, OCI or equity, the same place the effect of deferred tax will be booked in the similar way in PL, OCI or equity. And in case of the business combinations, DTA, DTL is recognized at the acquisition date and it affects the amount of goodwill or bargain purchase, and entity does not recognize DTL arising from the initial recognition of goodwill. To understand IND AS 12, we need to understand some terminology that what is the difference between accounting profit and loss versus taxable profit and loss. And on another side, we need to understand what is the current tax and what is deferred tax. So we need to understand some of these terminology to understand IND AS 12. So let us first discuss what is the accounting profit and taxable profit. While presenting the deferred tax assets and deferred tax liability, question arises regarding the offsetting of both. So in case of current assets, if we have legally enforceable right to offset DTA with DTL and entity has intention to settle it on net basis, we can offset the deferred tax assets with the deferred tax liability. And in case of deferred income tax, if current tax can be offsetted and it is applicable by the same authority, in that case we can offset the DTA and DTL. This is all about the summary of IND AS 12 income taxes. So if you have any question or you need any clarification, you may contact on the WhatsApp number given on the screen. Namaste.